One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. My name is Alex Mason and I am your host. This is the only podcast dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. I'm so grateful that you're here with me today, and we're going through discounted cash flow, going through all those basic questions. And what I want to talk to you today is about the cost of equity. We've been talking about cost of equity and WACC in general, weighted average cost of capital. But today I want to talk about the cost of equity calculation. You see, we talked about cost of equity in one sense in previous episodes, and let's just go over what that is now. We know that cost of equity equals our risk-free rates plus beta multiplied by the equity risk premium. That's the equation. That's it. That's how you calculate cost of equity. Now, of course, how you get those betas, the equity risk premium itself, that's all dependent, and there's some different approaches about how to get that. But it's all based on something called the CAPM, which stands for Capital Asset Pricing Model. And it's basically part of economic theory. And the question that I have for you today is this. So we have cost of equity, but how do we calculate cost of equity without using the capital asset pricing model? Is there another way than the formula that I just mentioned that we've gone over before in previous episodes? And the answer is yes. Another formula exists, and it's important to learn it because it can help us in situations where maybe we don't have that beta number. Maybe we aren't able to get a good equity risk premium. And this is the formula. Cost of equity equals dividends per share divided by share price plus growth rate of the dividends. So cost of equity equals dividends per share divided by share price plus the growth rate of dividends. Now, why does this make sense in some cases? Why would you ever use this formula? Well, for some companies, especially large and mature companies, there just aren't enough good opportunities for them to use their excess cash flow in terms of reinvesting in their own business at a high rate of return. They're already really big, they're already really mature. So what do? They reward their shareholders by paying out dividends. And remember, dividends, you're just paying out cash to shareholders. So in this case, a lot of the company's cash flow is used for dividend payments. And so you might use this for those type of situations. Now, you might also think about it from the perspective of if you're trying to come up with a weighted average cost of capital or a cost of equity more specifically for a company, and you don't have a good beta that you can find, or it's really hard to figure out what the equity risk premium should be, if that company pays dividends, maybe you can use this formula as an alternative. And the way I think about it is this equation is essentially the dividend yield of the stock plus the growth of the dividend. So that part of the equation that I mentioned before, dividends per share divided by share price, that is the equation for the dividend yield on a stock. So if you have a stock that is trading at $100 per share and pays out $3 per share in dividends, the dividend yield is $3 divided by 100, which equals a dividend yield of 3%. And you would see companies like that in the market right now, actually. And then the growth rate of dividends, how quickly is a company raising its dividend? And the way I see that is when a company raises its dividends, it's using that as a signal to the market that it's expecting good, strong cash flow in the future. So that's kind of how I see it, kind of as a proxy for overall growing levels of free cash flow. But that's a way to calculate cost of equity, an alternative method. Okay, so that is what I got for you today on Investment Banking Insights. Thank you again for joining me. I am Alex Mason, your host. And next time, we're going to be talking about another aspect of weighted average cost of capital. All right, I'll see you there.